Hello, assalamu alaikum everyone. Today the topic I will cover is cost of capital. The question I'm going to do is from the Principles of Corporate Finance book, 10th edition, chapter 9. The question is number 14. So what we are given is the capital. We have to find the cost of capital for a company. We are given some information. We are given the amount of loan that the company has outstanding, the current yield, the number of shares, the price per share, the book value per share, and the cost of equity, the expected rate of return on the stock. Now, the first thing we need to do is, because we have both debt and equity in this capital structure, the cost of capital will be equal to your WACC. So we are essentially calculating the WACC in this question. Ignore taxes. When you ignore taxes, that simply means that you have taxes of 0%. Okay. The first formula that we need to know is that the market value of debt is equal to book value of debt outstanding. These are equal because of two reasons. First, market value of debt and the book value of debt both are calculated through discounting. Thus, it's very likely that the book value and market value will be close to each other if the interest rates are relatively constant. Secondly, because of mark to market in many of the debt instruments, your market value and book value are very, very close together. So you can always assume that market value of debt is equal to the book value of debt. So the market value of debt is equal to 300,000. Now the market value of equity. To find the market value of equity, we will have to use this formula. Market value of equity is share price into number of shares outstanding. Now we are given two price levels, the price per share, market price, and the book value per share. Whenever you're using WACC formula, whenever you're calculating the cost of capital, use the market prices, not the book prices. So in any question where you're given the book prices, just strike them through. This is not of interest. So the market price per share is 50. So 50 price per share into 10,000 shares, that's about 500,000 market value of equity. Once we have the market value of debt and the market value of equity, we can find the market value of capital. Market value of capital is market value of debt plus market value of equity. That's 800,000 total capital. To find the weight of debt, all we have to do is divide the market value of debt by the market value of the total capital. So that's about 38%, 37.5%. Similarly, the market weight of equity is the market value of equity, 500,000, divided by the market value of capital of 800,000. That's again 62.5%. So now we have calculated all these things. Only two figures more needed. Cost of debt. We know that the current yield to maturity on the debt is about 8%. So this is the cost of debt. And cost of equity, the expected return on the company's stock, what we are expecting to give to our shareholders is about 15%. Now we have all the information to calculate the weighted average cost of capital. The formula for the weighted average cost of capital after tax weight is 1 minus the tax rate. Since we are already ignoring the effect of taxes, this is 1 multiply by the cost of debt, 8%, multiply by the weight of debt, the market weight of debt, which is 37.5, plus the cost of equity, 15%, multiply by the market weight of equity, 10%. So this is about 12%, 12.43. 12.38%. So the weighted average cost of capital is 12.38. Whenever you're finding weighted average cost of capital, always remember to use the market values. Never use the book values. Thank you for watching the video. Please like and subscribe.